It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. We are managing your financial future. Thank you so much. Welcome back. Johnny Dean, your podcast host, not your advisor, but here with the advisor, Professor Plum. Welcome back, Professor Plum. Nice to have you again.
Thank you.
So much to talk about. I think before the end of the year, we said, well, there's not probably a whole lot of stuff happening with, taxes and all that stuff because they hadn't passed the Secure Act 2.0. I don't think. When was it? It was a few weeks ago.
It was signed into... I think the 29th of December.
Yeah, and we had recorded the podcast before Christmas.
We took a little time off.
Yeah, we did. So we said, well, here's what's to look for in 2023. There's
not much out there.
And now we say, oh, wait, now we've got Secure Act 2.0. I mean, the stuff we said before still applies.
Yeah, now the Secure Act 2.0 was part of the $1.7 trillion spending bill that they passed just at the end of the year.
Yes.
And this portion of the bill has been debated and been bantered about for a while.
Couple of years?
Basically, since shortly after the original Secure Act was passed, they started saying, well, we need to do more. And so they finally got around to doing more.
This is a big blow to those out there who had hoped for a simplified tax form because that'll never happen. And you don't want it to happen. I mean, you want to have a smorgasbord of things to choose from to try to, get your tax bill down.
Right. I mean, we had about as simple of a tax return as you can have back in 1987, 88.
Right after the 86 tax reform.
We had 2 brackets and very few exemptions and deductions.
Nobody liked it.
And, most people, normal people, liked it okay. It was Congress that didn't like it. They couldn't manipulate us that way.
Well, I mean,
opinion.
I think most of us, you spend a good amount of time looking at people's taxes and saying, hey, how can we make these lower, right?
Right. But that's not saying that I wouldn't like to be able to make it simpler.
Yeah, I suppose. But
because I make a living doing this stuff doesn't mean that I'd still like to get it simpler so people could do their own.
Would you prefer to have simpler taxes as opposed to all these options we're going to talk about today?
Simpler taxes, other than what they used to call the Clinton tax reform, which said, how much did you make? Send it. Yeah, that was simple. I didn't like that idea. That was just a big joke back in the 90s.
Okay.
The Clinton tax form in the late 90s they came out with as a joke.
Right.
It just basically said, what did you make? Send it.
Oh, I get it.
That was real simple. But to the extent that, but they'll never be simple. They can't be. Accounting is just too complicated to make sense. What is actual profit? What should and should not be taxable?
What is income?
What is it? Define income. Is it, and define the type of income. Is it capital gain? Is it ordinary income? Is it interest, dividends, whatever?
No, you don't want. I personally believe, as many people say they want a simple tax code. No, I don't think you want that. There's just no way to do it. Anyway, so we're here to talk about Secure Act, as they say, 2.0, which came on the heels of Secure Act 1.0, which was a number of years ago, not that long ago.
And the big thing about Secure Act 1, the original 1.0. That's the one that gave us big time changes in beneficiary required minimum distributions.
Yeah, that
really took
changed
away the stretch rules. It did a lot of things that were fairly sizable in nature as far as how things happened. I mean, it postponed the required minimum distribution age to 72, but then it took away the stretch option for the majority of beneficiaries. There's nothing quite as earth-shaking, so to speak, in the 2.0, there's just a lot of them.
Yeah.
There's over 100 changes to retirement plans and things.
And we are not going to talk about all 100 changes. We are going to pick, we've kind of cherry-picked the 5 or 6 that are relevant to you folks listening to our
average
podcast.
Person.
Yeah. And let's start with the required minimum distribution, since you mentioned it. It was 70.5 for decades. And it changed a few years back to age 72. And now, Professor Plum, here in 2023, we have a new age.
Yes, for required minimum distributions, your beginning year is the year you reach age 73. So if you had a required minimum distribution last year because you turned 72 or older last year, you have a required minimum distribution this year. If you did not have a required minimum distribution last year because you weren't 72 last year, you don't have one this year. because you won't be 73 this year.
Yes, if that would mean you turn 72 in 2023.
Right. So the issue is if you were born before 1951, you have an RMD. If you were born in 51 through 59, you have a required minimum distribution starting the year you turn 73. And if you're born in 1960 or later, they've added another layer. They're postponing it again for people born in 1960 and later. Your required minimum distribution age will be 75. So you do not have to take any money out until you're 75 if you're born in 1960 or later.
So it's age 75. There's no age 74.
No, they didn't. So they didn't gradually. They're bumping it up. All
right, 75.
But right now, if you did not have an RMD last year because you did not turn 72 last year.
Yeah.
But you were expecting to have one this year because you thought you were going to turn 72. You're going to turn 72 this year.
Right.
You get one more year. That's assuming you didn't need the money to live off of anyway.
Well, if you need the money, you're probably taking more. All right. So new requirement. What does this do for people? What does this do for people's planning?
Well, from a planning perspective, for those people that did not necessarily need to take the required minimum distribution, or they have the ability to take money from other sources, it gives them one more year of potential Roth conversions. To be able, just because you don't have to take the money out of the traditional IRA, traditional 401k, doesn't mean you shouldn't be taking some of it out, but you have the control. You cannot convert an amount equal to a required minimum distribution. But if I don't have a required minimum distribution and I can live off of distribution of principal from my personal account, and I have room in my tax, my tax bracket, I can now take the money out and convert it to Roth. So I can reduce the growth in my IRA, traditional IRA, to some extent, in many cases, and turn it into Roth, where if I had the RMD this year, then I wouldn't be able to do it to Roth. I'd have to take it out. I could invest it, but that investment would create taxable income on my return if it succeeded in actually being positive returns.
So this gives you a little more time.
A little bit of leeway.
It can be. I think this is probably a good thing. I mean, you don't want to get rid of it completely, but I think this is a good thing for people who are looking to, potentially get more money out of their pre-tax
a little bit more
qualified
control
accounts
for another year.
Yeah, we've talked about this especially people taking their Social Security. Maybe it gives them a little bit more, a better chance to avoid taxation on their Social Security, that kind of stuff. All right, so RMDs changed immediately. You know what this means? That if you're listening to our old podcast, when we said age 72, we said we changed all of our webinars and all that stuff to say age 72. Now we got to change it again to age 73. But this should stick for the next.
I mean, I don't know when they're going to change it again, but remember, they started talking about Secure Act 2.0 right after Secure Act passed.
Yeah.
And these were a lot of the changes that they wanted in the first one, but they couldn't get in the first one.
Now they can.
And now they got it in. So maybe they'll be, happy for a little while, not mess with it for a little while, so we can digest these rules and before they change them again on us.
Okay. Now, Roth IRAs. Now, the note I have here says effective 2024, no RMDs for Roth.
DRA, designated retirement account, meaning a Roth 401k,
right?
Roth 403b.
The Roth IRAs don't have Roth IRAs do not have
right, but a
RMDs,
Roth 401k did have a required minimum distribution, and so one of the big things was that when you got to retirement age and before you got to required minimum distribution age, you kind of wanted to make sure that you changed everything 401k over to IRA, especially the Roth side of the house. So you did not have a required minimum distribution from that Roth 401k. Well, with Secure Act 2.0, they removed the requirement for the owner of a Roth 401k or other designated retirement account, Roth 457, Roth 403b.
Workplace Roth retirement plan.
They no longer have a required minimum distribution. So one of the pushes for a broker or somebody who wanted to control your money, help manage your money, was you don't want to leave it in the 401k because you have a required minimum distribution from that Roth 401k. Well, that reason is gone because now you do not have a required minimum distribution from that designated Roth account. Now, the other rules and the other reasons to potentially move money from a Roth 401k to a Roth IRA still exist. The fact that the distributions in a Roth IRA are qualified distributions. And if you've only recently created that Roth 401k, there could be some taxability of distributions in the early years if you start taking it. But that's only a very small number of people.
That doesn't affect too many people. But this is another nice change, I would say.
Yes.
All the other stuff remains the same with Roth 401ks,
yes,
right?
But they did take away the required minimum distribution from that.
Starting in 2024. That is not this year. No, next year, starting in tax year 2023.
So if you turn 73 this year and you have a Roth 401k, you still have a required minimum distribution. But potentially you don't have one next year.
Well, what do you mean?
If I turn 73 this year and I have a Roth 401k,
yeah,
and I'm not working for the company anymore, I do have a required minimum distribution.
Because it's 2023.
And then next year, if I leave the money with the 401k,
then you can't.
I won't have a required minimum distribution.
You won't have that. In fact, you won't have one going forward after that.
Right.
So, but yeah, that's important. You know that it's not 2023; it's 2024. Let's see. What do we want to? What else? Well,
there's a fairly big push by Congress. They've done a lot in the Roth world.
Yeah,
they want more Roth. They want you to save, but they don't want to give you the tax deduction. They want you to save in the Roth world. So they're basically now allowing for simple plans and SEP, simplified employee pensions, to be Roth. So if you work for an employer,
which we didn't have before.
No, all those contributions, the company contributions, and actually your own contributions in those areas were always pre-tax. Now, for a business owner that did a SEP, they could convert it right away. Simples are more difficult because you can't convert those in the first 2 years, but you have some opportunity after that. But now they can just be a flat out Roth, account. Now, if I work for somebody who provides this SEP retirement plan, and each year the employer puts money into my SEP for me because that's how SEPs work, and the employer decides for whatever reason, and I agree, that they put it into a Roth SEP, it's not tax free to me. That contribution is taxable to me when.
It's like a Roth.
The money goes in. So, like if they put in, $5,000 as the SEP Roth contribution, my adjusted gross income for this year is going to go up by $5,000.
Sure, of course. Yeah, that's generally how the Roth.
That's how Roths work.
That's how Roths work.
In the past, it would just go into my account, and it would be a traditional IRA for me going forward.
I don't know how many companies are going to be setting up these things because, again, it does cost money and there's time involved and you have to keep track of certain things. And I think it might be a bit of a headache at first, but at least they're
a lot
opening
of the things
that door.
That are happening that are effective for 2023 may not happen in 2023 if it requires reworking of the plan document, reworking of legal documents, and setting up systems to allow for tracking and for managing and things, because it's a lot for a company to take in that quick.
Very quickly, a few more points here. Employer contributions.
Again, getting back to the idea that they want more Roth, they're allowing catch-up. Is that where you're heading, catch-up?
Yes.
The catch-up contributions for people 50 and older, they can now, in the past, we were putting them into the 401ks. Well, they can now go Roth.
Catch-up contributions
and
for those
matching contribution from the employer can now go Roth,
which they could not do before.
No, all money from the employer always went into the traditional side. But I can now ask them to say, I don't want it in my traditional, put it into my Roth side. But again, it's not tax-free going in, tax-free coming out. It's going to be an increase in my taxable income in the year the money goes in. The company gets to deduct it either way. They don't care what either way, because if they put in $5,000 as a matching contribution, they get to deduct it.
Of course.
The issue was in the past, if I had a Roth 401k and I was putting in my X amount of dollars,
but your employer matched,
and the employer matched it, it always went into the traditional side,
which we always made a point to remind people. By the way,
now you're going to have a choice. Do you want it to go into the traditional 401k side and not be taxed on it today, or go into the Roth 401k side and be taxed on it today, but be potentially tax-free for the rest of time?
Let me tell you, for people in that situation, before you decide to elect to put it into the Roth side, I would check with your financial advisor. This is stuff that you need to go over because this will change potentially. This could change depending on how much big the match is, this could change your tax situation considerably.
Right. And getting into the weeds on this, there's 3 types of ways an employer can put money into your plan: through a mandatory match, through a non-elective contribution where they have to do it for top-heavy rules and things like that, and or through a profit sharing where they're just feeling generous and including. The profit sharing portion cannot go Roth. The non-elective and the matching contribution can go either way, but the profit sharing portion, which is a variable number which can go up or down, cannot go Roth.
I'm sure there's a reason why, but I'm not going to get into it because it doesn't affect anybody. The reason doesn't matter. Let's see. Okay, so is that starting immediately in 2023 with these matching contributions?
The matchings, yes, but like I said before, I do not expect the matching contributions to be really eligible for 2023 because that's a lot of legal work to redo the plans and everything for that quick.
But the law allows it.
The law allows it.
Okay.
Yeah.
Let's move to the 529 plans. Now, we had a question from somebody last year, as I recall, talking about money in a 529. Now, the 529 plan, for those that don't know, is the college savings plan. Generally for, it's college. It's not, you can only use it for higher education expenses. And you put money into this savings plan, you let it grow. And the idea is you can take the money out, earnings out, tax-free if they are used toward
qualified higher education expenses.
Right, which is generally tuition and things like that.
Yeah.
Now,
one of the things in the past was we warned people, or cautioned, I should say, do not overfund these, because if you have money left over in them after the beneficiary is done with school, any earnings that come out for non-school purposes are taxable and penalized. And so
no matter how old you are, this is not one of those things where the penalty goes away at 59 and a half.
So it was, we want to, there's a big difference between a state school, private schools. Make sure you understand where the kid's going to go. You don't really want to overfund these. Well, with this new Secure Act 2.0, there may be a reason to overfund these a little bit.
Well, and can we nutshell this for people so that
right? But this is something you have to do well in advance of planning. I mean, this is planning long term out, because if you have a 529 plan that was started 15 years, it's more than 15 years old.
So it's an old.
You've had a 15. You started it when the kid was 5. And now the kid's 20 or older, and you realize they're never going to school, or they got scholarships.
They got a scholarship.
They didn't have to use any of the money.
They are a heck of a sports person, and let's look at it that way.
Either side,
or they made $10 million on their startup company, and they did it right out of high school. Yeah, exactly.
But for whatever reason, you end up with money in the plan, in the 529 plan. Well, the money in the 529 plan can be used by the beneficiary. Usually the kid in this case, the beneficiary of the plan, as you can transfer it to a Roth IRA and treat it as your Roth IRA contribution. Now, this assumes you haven't made any other IRA contributions, that you're eligible to make it, the person's working, has earned income. The nice thing, though, is there's no income limit. So somebody who they've got money in their 529 plan, and so now the kid can use up to $6,500 a year as a Roth contribution from 529 to Roth, tax-free, penalty-free, and they can build up their Roth IRA with this money, assuming they're working, and they can do this for up to $35,000 worth of contributions. So
so let's say I have $26,000 sitting in a 529 plan, right? And my kid is 21,
and it's been in there for 15 years,
right?
I've been saving of its earnings.
So I've been saving for a long time, and a good half of it is earnings. And they're not going to school. Doesn't matter the reason. Don't need but it. This is not going to be used for education. In prior years, I would have had to find someone else to give that money to.
Either give it to a nephew or another sibling or something, or take the money out and pay taxes and penalties on that earnings portion.
Right, which I probably don't want to do. I could do. But now I can say, all right, kid, you're not going to school or whatever. You don't need this money for school. So I am going to now use this this money can now be given to the child in the form of
their Roth IRA.
Of a Roth contribution. So we say, look, we got $26,000 in there. We're going to take $6,500 this year.
Yep.
And now you got a $6,500 Roth. We're going to take another $65 from the 529 next year.
So the next 5 or 6 years, you're funding a Roth IRA for them, and they're building
4 years in this case. But yes.
Okay, you're only 26. I'm still in the 30. It's okay. A maximum 35,000. I keep working off the 35. You've built up that amount of money, and so it can be a great way, because a lot of times when people have leftover money in their 529s, it'd be like, I'd love to be able to use this to help them buy their first home.
Wouldn't that? Yeah.
But you weren't able to before.
Yeah. Well, not without paying penalties and taxes.
Yeah, I mean, you pay the penalties and taxes.
Which you're probably in a pretty high tax rate at that point.
And buying a home is not a qualified higher education expense, so that's why you get the taxes. But this way you can use it to help fund the Roth IRA. And then if it really is a first-time home buyer, and if the Roth IRA has been in existence for 5 years, we can use all the contributions in that Roth IRA. Now, they do retain their character when the money goes across. So in your example of $26,000, 13 of contribution or 13 of principal, 13 of earnings in it, you would have $13,000 of contributions of after-tax money to the Roth IRA and $13,000 of earnings. And you want to buy 5 years into this, you want to buy a first-time home purchase? I can take the $13,000 of contributions out for any reason, and another 10 of the earnings tax-free and penalty-free for a first-time home purchase.
Yeah.
This is a great way to potentially help, to help a kid save for a first-time home purchase.
Yeah,
many years from now.
Well, it could be only because the Roth rules allow that. Now, remember, once the kid has all this money in their Roth, as you said, there's some of it is earnings, presumably, and some of it's principal, of course. The Roth rules still apply to them at that point.
They do. It's a Roth at that point.
Right. So they may have to wait till age 59 and a half in order to take that out.
Now, some people may not be quite so benevolent to their kids, and they say, well, wait a minute, I put this money in there for education. They're not using it for whatever reason. I don't want to use it for just give it to them. We can change the beneficiary of a Roth. Now, this is not 100% locked in stone yet because they didn't address it. This is based on current rules and the way they wrote the law. There is no issue with this, but they could add it. We can change the beneficiary. We know that on a 529 plan, I can change the beneficiary to a certain number of people, including myself.
So if I have this $26,000
I'm the owner of the 529, my son or daughter is the beneficiary. Right. They don't need it. I can change it to another sibling, another relative, or I can change it to myself.
Let's go that route.
And I can use it for my education if I wanted to go back to school. Maybe not. But what about other issues? If I'm still working, I can then change it. Presumably, under the way the law is written today, I can change the beneficiary to myself. The 529 has been in existence for more than 15 years.
In this example that we're giving.
And I can start using the money to help me fund my Roth IRA. And let's say that I make 200, 300 million a year. Yeah. I'm way over the limits for funding a Roth IRA. As long as I have my earned income, I can fund the Roth. There are no AGI limits for moving money from a 529 to the Roth IRA.
Yeah.
In the past, I couldn't do it, but now I can. I can use the 529 man to get that $35,000 over to a Roth.
You're saying, though, they haven't addressed this. It's not
they haven't
mentioned
addressed
anywhere.
The change of beneficiary. They haven't addressed
so what we're doing is taking a little bit of a leap, saying that I could take my 529 money for my kid who ain't going to college.
We're looking at
and
existing law.
I could potentially, as far as we know, use that money and set up my own Roth contributions, no matter how much money I'm making.
In the 529 world, there is no prohibition of me changing the beneficiary to myself. In the written document of the Secure Point 210, there is no mention of you can't. They did say any money that's come into the 529 via contributions in the last 5 years are ineligible to be transferred.
Oh.
But if anybody's put any money in the last 5 years, it can't go over. Only money that's been in there more than 5 years and the account's been open for at least 15 years can go. But they didn't mention anything about change of beneficiary negating any of this. So we're taking them at their word.
So wait, you can't put in the Roth any money you've contributed?
Not the Roth, the 529. Yeah, we can't transfer from the 529 to the Roth. So let's say of that $26,000 that you have left over, 6 of it came from contributions over the last 5 years. You can't do that 6. You can only do 20.
I don't know. That just added a level of complexity to me that's totally unnecessary.
And what I'm saying though is,
whatever.
Under the way everything's written, what we just talked about is totally legit.
Okay, all right. As of at press time, as they say,
they may come back and say our intention was never this,
because you seem to be benefiting from this.
Oh, you definitely are.
So we don't want that.
Yeah, and you're most likely to be over the limit. You're more likely to be over the AGI limit, to make for Roth contributions than that 22-year-old child.
Oh, of course, I would assume it could be. I mean, the odds are.
So we'll see if they make any changes to this in the future. We'll see. But as of the way it's written right now, It is a planning potential opportunity.
So, all right. So we've talked about RMDs changing, which is probably for our listeners the biggest change. We've talked about the catch-up contributions, talked about no RMDs for Roths, and a few other things. What else is in here that we can cover?
Well, there's an additional catch-up contribution for a limited number of people. And I think this is one of the stupider provisions, mainly because I can't participate in it. But anyway.
Well, take your own opinions out of it for a moment. It seems a little odd.
Starting in 2024, if you are 60 in that year, if you turn 60 in that year, 61, 62, or 63.
If you turn any of those ages,
your catch-up contribution is equal to 150% of the traditional catch-up number. Now, for 2023,
let's talk about
401ks.
401ks, but not, what about IRAs?
I think it affects that one too, but no, it's 401ks.
So just 401ks.
I believe so, yeah.
All right.
The catch-up contribution is going to 150%. So in 2023, the catch-up contribution did increase quite nicely from 2022. It is now $7,500 for somebody who is age 50 or older. So you get the 22.5, which is the new 401k limit for 2023, plus the $7,500. Now, if you are starting next year, I don't know what the limit's going to be, but it'll be $7,500 or more for the catch-up. So if you are 60, 61, 60, it starts in
60, 61, 60, 61, 62, or 63 years
old.
Oh,
yeah. And this doesn't start until 2025. But if you're one of those ages, you can put in 150%. So if it were going into effect this year, which it's not, your catch-up would not be 7,500, it'd be 11,250. So it's a nice additional catch-up. And what I've noticed is a lot of people that get into that age are saying, I need to do more catch-up before I retire at 65, 66, whatever age I'm retiring. And so that's a nice little bump. But it's only for the people that turn that age in those years. It's kind of weird.
It is strange, but it gives you an additional, 4,000 something, whatever, potentially more money to defer into your 401k.
Or your Roth 401k.
Or your Roth.
Now, there is another deferral issue coming up, and this is going to affect people starting in 2024.
Okay.
On the catch-up. This is specific to the catch-up, 401k catch-up contributions, 403b, 457 catch-up contributions. Starting in 2024, if your income was $145,000 or more the previous year, your catch-up contribution must go to Roth, not an option.
In other words, that catch-up contribution is not tax deductible to you. The entire thing?
You can, any amount that you're putting in as a catch-up contribution. Now, you may or may not be maxing it out, but if you were maxing it out, the $7,500 that you put in has to go to the Roth side of the house.
If you're making at least
$145,000 of wages.
Is this married, single?
Well, that's per person. That's my wages from that employer. My spouse's wages from her or his employer.
Okay.
And it's
all right.
So if I change jobs, it doesn't affect me.
Okay.
Because it's the previous year's wages from that employer. So if I change jobs, mid-year, let's say I make $300,000 a year.
You make 100,
and I make let's say I make $280 a year.
Yeah, $280.
So I make $140,000 the first half of the year.
And then you go to work for the guy across the street.
Yeah, I don't. Even though I made $280 a year before, it doesn't affect. It's only wages and it's only wages. So a self-employed person, sole proprietor, doesn't have this issue. It's only, and I think the reason they did was because how are they going to check up? I mean, they're going to put the onus on the employer that says if you made more than 145,
it's 145, not 140.
145
because we said 140.
It's 145.
All right.
So the employer can track this a lot easier than them saying, well, you're a new employee. What'd you make last year? Oh, I made 137,000. I mean, you actually made more. So that's,
all right.
So but it's going to happen. Now, the thing is, if your employer doesn't offer a Roth option on their 401k and you cannot put money into the catch-up contribution because there's no Roth option, then nobody can do a catch-up contribution.
You mean an additional catch-up? Nobody can do an additional catch-up?
Nobody can do any catch-up. If you've got people that make under 145 and people that make over 145. And the people over 145 cannot do a Roth catch-up because they don't have a Roth option. Then the people under 145,000 aren't allowed to do a catch-up contribution anyway, or either.
Wait, so the whole catch-up provision would go away?
On that company's plan. Now, a lot of people making less than 145 may or may not be able to do the catch-up, but that's not the issue because they may be a spouse that's, for somebody that's working. If the Roth option is not available, so this is a push to do more Roth.
Yeah.
This is a push to force companies to allow their employees to have that Roth option. But it won't be an option for the catch-up contributions starting in a year or two.
Again, I don't know why that's. This seems like going from point A to point V.
They're
point
trying
B
to get more
via
Roth
point
money.
Z.
And where do the taxes come in the best from Roth money? Higher wage earners. So this is a way to get higher wage earners to pay more taxes.
But they don't even get their taxes until after the year is over. So it makes no sense whatsoever.
Whether it makes sense or not, we're talking about Congress, and this is how they're selling it.
All right,
but yeah,
so
they are pushing for a lot more Roth, and this is one way they're going to try to get more Roth.
Well, if that's the only way they got it to pass, then okay. I don't know. Okay, anything. I realize this is getting complicated, folks, and I don't mean it to be. I want this to really focus on the things that affect you guys listening, you people listening, the most.
I think it's important to look at things that it did not change.
Okay, let's run down. We only got a few minutes, but let's run those down.
It did not change the age for QCDs, qualified charitable distributions.
So 70 and a half.
Still 70 and a half for those, even though the required minimum distribution age has increased.
Okay, that's all right. That's
it did
fine.
not change Roth IRA funding issues. It did not change backdoor Roths, mega Roth contributions.
Which I honestly thought would have been addressed by now.
They are not. In fact, they're maybe pushing more for Roth. So, that they maybe were feeling good about those things, but they did not touch those in any way, shape, or form. And so that's a nice thing. A lot of people have asked, what about QCDs? Now, they did add some things to QCDs, which I think are kind of stupid, but they did not change the age. We'll just leave it there. So if you're 70 and a half or older, you can still do QCDs. It's not an issue. Even though they changed the required minimum distribution age
That's
again,
good.
It didn't affect. They did not change backdoor Roths and things of that nature. One thing they did change for the lower wage earner is the savers credit. I don't know if you want to talk about that.
Yeah, we can do that. I think that's. Can we explain very quickly how the savers credit worked before?
Yeah, there was something called the savers credit that if you were a lower income, $35,000, $40,000 or less, and generally much less, if you put money into an IRA, a Roth IRA, a 401k, or any kind of retirement plan, then there was a non-refundable credit of anywhere from 10 to 50% of the amount you contributed. Maximum contribution they would count is $2,000. So you could potentially get $1,000 tax credit if you put $2,000 into in a retirement plan, a Roth IRA, and you didn't just immediately take it back out.
Well,
It has to stay there.
Yeah.
Not that many people, unfortunately, took advantage of it or qualified for it, but it was a credit. And so you would get the money back into as a refund, assuming you owed taxes. It was a non-refundable. So if you didn't know,
assuming you paid taxes in the year, you could have gotten a refund. But
Right.
assuming you
had a taxable event for the year that stayed. What they've done is they've changed the credit to what they call now a savers match. So instead of giving you a non-refundable credit back on your return, they're going to make a deposit into your retirement account on your behalf. So the Treasury will put a check into your retirement account. And it's a match. So now it's in your retirement account. You got to deal with the retirement account.
Whereas before, you got to just keep the money because it was a tax credit.
Right. And so that was, it's a little bit different. But
Well, all right. I take the cynical side.
Go ahead. The only other one I wanted to bring up was
student loan.
Yeah.
Yeah. Let's just cover that very quickly because that does affect a lot of people that we
assuming
know.
your employer wants to play ball. Yeah, this is up to the employer discretion. And again, this is one of those ones that's available pretty immediately, but don't expect it immediately because companies aren't going to be able to ramp up that quick. But to the extent, because a lot of times, the discussion is, what do I do first? If I pay off my student loans, I can't afford to put money in my 401k. But if I put money in my 401k, which I really need to do and let it grow and compound for the next 20, 30, 40 years, I'm going to be stuck with this student loan debt forever.
Right.
So you're stuck between a rock and a hard place. Well, what this does is allow a company to treat the money that you pay towards student loan debt as a matchable issue. So if I was going to pay $5,000 into my student debt, or I was going to put $5,000 into my company plan, and I wanted to get a match, maybe they did a 50% match. They were going to put $2,500 into my plan. If I put $5,000 into my plan, that makes me want to put the money into the retirement plan. But I also want to get rid of this dadgum debt. Now I can say, well, I'm going to pay the money on the debt, and the company will look at that and say, that's part of the contribution that we're going to consider as matching. So we'll still put the matching contribution into your retirement plan. Even though you didn't put any money in your retirement plan, you paid off student debt. We're going to match that the same way as if you had put it into the plan.
So if I had $5,000 that I wanted to put, and I say I can either put it toward my 401k
and get a $2,500 match,
and get a $2,500 match, or I could put it toward my student loan
and reduce that debt.
Right. So now
but
you
I
can
missed
say
out on the match.
Right. So now you can say, I'm going to put it toward my student loan.
Right.
And my employer, if they play ball.
And if they match,
they can.
They'll put the $2,500 in as if I had made the contribution. They'll match it.
Yeah.
Now I'm not giving up on the matching contribution, because before it was like, I really want the free money from the matching contribution, but I can't afford to not pay down my debt. So I miss out on the free money and I miss out on the compounding. This way, you
at least get.
Right. And the good news also is the IRS is saying that the employer is able to take the employee, take their word on it. They self-certify.
Oh, you don't have to go with a receipt saying, here's my statement?
That's what's yet to be seen. What is the company going to be required to show that, that as proof that you made a contribution, or not a contribution, a payment to your debt?
Okay. So you're on the honor system there, as far as we know.
Yeah.
All right. Well, does that about cover it? I mean, this does not cover everything.
I think there's about 97 more provisions. Yeah. The reality is most of them don't apply, although the one that's very minor is the catch-up contribution on IRAs is now going to be, we used to have IRA contribution limits, 401k contribution limits, 401k catch-up limits, and we had IRA catch-up limits.
We don't anymore?
Well, 3 of those were all indexed for inflation. They were going up automatically based on certain CPI numbers. The IRA catch-up was never indexed for inflation. It was always an act of Congress.
It was like $1,000 for years.
It's been $1,000 for quite a while. It was $500 for quite a while.
It was.
Then they finally got around to raising it to
so
$1,000.
now it's going to be.
Now it's going to be indexed.
Starting now?
2024. Starting in 2024.
All right.
Now it's not going to. You're not going to see it go from $1,000 to $1,087.50. It's going to go up in increments of 100.
That's fine. Yeah. Well, that's good. Wow. A lot to cover here, folks. And believe it or not, with all these provisions, there's a decent likelihood, I would say, that these one or several will affect you. And it could affect you in a good way. But it's so much to read through. My advice to you would be to start meeting heavily with your Lucia Capital Group advisor. You get my reference.
Old Animal House reference.
Absolutely. No, but really it is, because you may not know with all these provisions how it could affect you. There are certain things that if you do it properly may give you a decent amount of, tax savings, may allow your money to grow.
It's all about being efficient with your money and using the laws to your advantage. So you have to know the law to be able to use it to your advantage. And so we've got a bunch of new laws.
Right.
How do we take advantage of them?
Yeah. So this is kind of a Christmas gift, like people who enjoy this stuff like you. It's like, wow, look at this new stuff. How can we use this? This is kind of cool. Check with your Lucia Capital Group advisor and talk to them. Professor Plum, have you read the whole thing?
I've read the bill. It's very cumbersome. So I took down notes. I sent you a copy of my notes.
I saw it. Yeah.
And then
4 pages of bullets.
It was 5 pages of bullets, and I was so boom, boom, boom. And then I went and started reading other people's summaries of it, people that I respect in the financial planning world, and big companies, and to make sure that their interpretation of what I read was the same as my interpretation. And then where there's a difference, I go back to the original and say, which one do I agree with more?
Well, they should be looking at your interpretation and saying, maybe this guy is right. Yeah. I don't know. But anyway, you read it. I can see the mark in your head from where you fell asleep and bashed your head on the desk. But talk to Lucia Capital Group advisors. Professor Plum can help you out. Any of the Lucia Capital Group advisors, 800-644-1150. This is a great opportunity. And speaking here early in the year, it's early enough in the year.
The one we didn't talk about?
What?
the penalty for missing required minimum distributions.
Oh, you want to throw that in very quickly?
The penalty's going down for all the people that got caught in the past, which was never anybody getting caught. The penalty used to be really bad at 50% of the shortfall of your required minimum distribution. Now it's only 25% if the IRS catches you. If you catch yourself and correct it before the IRS catches you, it's only 10%.
That's how the law stands.
That's the way
now,
it's
we
written.
have said in the past that if you find it yourself and you say, I made a mistake, here are the reasons why, I've corrected it, there is a chance that they may not penalize you at all. I'm not guaranteeing that, but we've heard instances in the past where that happened.
I've heard that they're going to go after it harder because they need to, and maybe this is a way to make it easy. I don't know.
I don't think they will.
But they've reduced the penalty.
I can't, well, all we can do is go by what the law says.
Right. And
so
try to avoid the penalty if you can.
There you go. See, it's another provision. This is stuff you need to know about. That's why we tell you to talk to the folks at Lucia Capital Group. Again, 800-644-1150. You can also find us online, luciacap.com, LUCIACAP.com. You're going to find more of this stuff. I think we'll probably put a video together on a couple of these provisions.
The high points, the most popular.
Certainly the required minimum distribution stuff that's changed and how it can affect you, maybe a few other things. But you can find blog posts and videos and all that stuff at the website, luciacap.com. Also, don't forget to subscribe to us. We're on Apple Podcasts now.
Oh, wow.
Yes.
I say that like I actually know what that means.
Well, Spotify, of course, but we're also on Apple.
Yeah.
Which, for compliance reasons, I was told we weren't allowed to be on Apple, but now I'm told we are.
Well, good.
So that's good. That's what I was told, and I'm announcing this now. So
it better be right.
It better be right. Exactly. Find us, subscribe to us wherever you can find us, Managing Your Financial Future. Get these episodes and listen to them because I can't guarantee it, but I can almost guarantee that you'll be a little bit smarter financially if you follow us and listen to our podcast. My thanks to you, Professor Rick Plum. You're a CFP professional. I'm your host, Johnny Dean. Got more to talk about next time, and if you have any questions, certainly you can email us as well there at luciacap.com. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Earnings from a 529 college savings plan can grow tax-deferred and may be withdrawn free of federal taxes when used for qualified education expenses. Non-qualified withdrawals are subject to a 10% penalty tax. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.